Good afternoon, everybody. Welcome to session 3 of our Banking and Finance Academy sessions on LIBOR, SONIA and other interest rates. Today we are going to be taking a look at the transition from LIBOR to SONIA. I'm joined by a couple of the other members of the banking team, Nicola Watson and Martin Smale. So let's get started. Here is a note of what we are going to cover today. We will take a look at where we are on the transition timeline, a reminder of the key differences between SONIA and LIBOR, key concepts and language relating to SONIA, the use of SONIA term rates and non-risk-free rates, issues around tough legacy contracts, and we'll round off by taking a look at current practical issues around transition and what the next 3 to 6 months might have in store. To understand where we are on the timeline, we need to have a look at what the working group say. As a reminder, the working group was set up by the Bank of England in 2015, following the various travails of LIBOR over the last few years. Its full title is the Working Group on Sterling Risk-Free Reference Rates, and as the name suggests, it was tasked to develop an alternative benchmark risk-free rate for use instead of LIBOR. In April 2017, the working group recommended SONIA as its preferred risk-free rate for sterling. Since then, the working group has been focused on the transition from LIBOR to SONIA across the sterling markets. On the 11th of January this year, the working group published its updated priorities and roadmap for the year. And here is our timeline. So where are we now on the timeline? We are closing out in Q3 and heading into Q4. So effectively, we're on the home stretch. LIBOR will cease on the 31st of December. So understandably, the top priority of the working group is for us to be fully prepared for the cessation of sterling LIBOR by the end of the year. By the end of this month, the roadmap calls for us to complete active conversion of all legacy sterling LIBOR contracts expiring after the end of 2021. The roadmap also states that if active conversion of legacy contracts is not viable, we are to ensure that robust fallbacks are adopted where possible. In practice, this means that at this point in the timeline, the working group calls for us to be looking at our loan contracts and assessing whether the fallbacks that are documented can be relied on as a primary transition mechanism. For tough legacy contracts that contain no fallbacks or inappropriate fallbacks and that just can't practically be amended by the time LIBOR ceases on the 31st of December, active conversion may just not be possible. For loan contracts that fall into this category, the FCA has been consulting on how it proposes to use the new powers granted to it by the government to use a synthetic LIBOR rate. This consultation closed on the 27th of August, and pending the outcome of that consultation in Q4, the proposed synthetic methodology would take effect after the 31st of December when LIBOR ceases. Nicola will take a look at the position on tough legacy contracts in a little bit of further detail later on. So that's where we are on the transition timeline. Clearly, with final deadlines and milestones fast approaching, it's important that we, together with borrowers and funders, work together to actively transition LIBOR referencing loan contracts as early as possible and where possible. Before I pass over to Martin, I'm going to provide a very brief reminder of the key differences between SONIA and LIBOR. There are really 3 key differences between how SONIA and LIBOR work, and the first 2 come hand in hand. 1, SONIA is a backward-looking rate, while LIBOR is forward-looking. And 2, SONIA is simply an overnight rate, while LIBOR is available over various tenors. SONIA, which we know stands for the Sterling Overnight Index Average, measures the cost of overnight borrowing on a backwards-looking basis. Because it is a daily rate means that, in contrast to LIBOR, the amount of interest payable at the end of each interest period will not be known until that interest period expires. Therefore, if you borrow a SONIA-linked loan today, you will not know your interest costs up front. LIBOR, on the other hand, is a forward-looking rate. It reflects the average of the interest rates that banks pay to borrow sterling overnight from other financial institutions. The cost of borrowing for the upcoming period is known, and so borrowers and lenders will therefore know at the beginning of each interest period the amount of interest that will be payable at the end of the interest period. For a loan contract which simply references SONIA over a term borrowing period, each SONIA fixing during that period must be collected and compounded. This essentially means that the daily SONIA rates for each day in the interest period need to be added up to give a rate for that period. To mitigate the effect of not knowing the interest costs up front, accepted practice is to use a lag period and an observation shift for calculation purposes. Martin will take a look at this in further detail shortly. Thirdly, SONIA is based on actual transactions and generally fixes lower than LIBOR. SONIA is based on actual transactions and daily transactional data and is tied to an active and liquid underlying market. LIBOR, on the other hand, is based on quotes obtained from market participants as to what they claim or think would be charged in interest to borrow money on a short-term basis from another bank. LIBOR is calculated to take account of the increased exposure and credit risk to funders and compensates funders for the risk of lending over a term period on a forward-looking rate. Whereas for SONIA, because it is simply a daily overnight rate, it doesn't include a credit or term premium like LIBOR does. And for this reason, SONIA typically fixes lower than LIBOR. For a LIBOR-linked loan, a funder will lend money to a borrower at LIBOR plus a margin, the margin being the funder's own profit element. And so the aggregate of LIBOR and the margin will effectively be the overall interest rate charged to the borrower. For loan contracts transitioning to SONIA, we need to make an adjustment to maintain the margin element. Martin will look at this point in more detail shortly, but by way of introduction, to bring the SONIA rate back up to the relevant LIBOR level, some funders will apply what is called a credit adjustment spread, or CAS as it is known shorthand. Other funders may have already factored the difference into the pricing of the loan, and so there may be no CAS on day one SONIA loans. However the funder may wish to deal with the adjustment, it is a point that needs to be addressed in loan contracts. The margin is the basis on which a funder would have made its lending decision at the time the loan was made, and so the spread adjustment ensures fairness. I'll now pass you over to Martin, who is going to take a look at key concepts and language relating to SONIA.
Thanks, Anna. So first of all, today I'm going to take a look under the bonnet, I suppose, of the implementation of compounded SONIA, just to explore some of the key concepts and language which you might encounter in practice. And to do so, I'm going to look at the Sterling Working Group's recommended approach, which is on screen just now. So that's a 5 banking days look back without observation shift using a daily non-cumulative compounded rate. And there's the option of a credit adjustment spread as well, as Anna's just discussed. So first of all, let's look at the 5 banking days look back without observation shift element of that. As Anna has just explained, one of the key differences between LIBOR and SONIA is that LIBOR is forward-looking and is provided for different tenors, while SONIA is backward-looking and is provided on a daily overnight basis. So instead of knowing how much interest will be payable at the end of the interest period from the outset, as is the case where the LIBOR is the reference rate, using an overnight backward-looking rate means that you will not know how much interest is due until the final day of the interest period. Clearly, this is less than ideal for borrowers, as they need to have at least some notice of how much interest they're due to pay and manage their cash accordingly. To deal with this issue, the prevailing convention in the market is to provide some advance notice by way of a lag or look back. What this looks like in practice is that SONIA is observed over a period which is the same length as the interest period in question. So, for example, say a month. But that observation period starts 5 banking days before the first day and ends 5 banking days before the last day of the interest period in question. This allows the interest payment to be known 5 banking days before the interest payment date itself, which gives borrowers a full working week to ensure that they have enough funds in the correct place to settle interest due on the payment date. So we've produced a fairly simple diagram on screen which displays generally how this looks. As you can see, the rate for the first day of the interest period is the rate for the day which falls 5 banking days prior to that first day. The same then applies for each day during the interest period. Where a day within an interest period is not itself a banking day, for example, a weekend day, the rate for that non-banking day, for the purposes of the calculation, is the rate for the most recent banking day in the interest period, taking account of the lag or look back. So now looking briefly at the observation shift concept, although the working group's recommendation is not to include an observation shift, it certainly is worth touching on that, what that means in the lag or look back context. So in the standard lag methodology where observation shift is not used, the number of non-banking days is observed on the basis of the interest period itself. Where an observation shift is adopted, the number of non-banking days is instead observed on the basis of the observation period. And this shifts the weighting of the daily rates back to the period during the period during which the rates actually occurred, rather than the slightly later interest period. So the use of an observation shift is linked closely to the use of published indexes. So for example, the Bank of England's published SONIA compounded index. And these allow for calculation of an average rate over a given period. However, the prevailing view in the market for the recommended compounded rate methodology is that the lag or look back without observation shift is the preferred approach due to the risk of there being a potential mismatch in the number of days between the interest period, which of course is the period over which the borrower is actually paying interest, and the observation period, which is in reality only being referenced as part of this lag or look back convention. It's worth noting that in practice, it is unlikely that using an observation shift or not will produce wildly different results in terms of the amount of interest which is payable by the borrower. So now moving on to look at the compounding methodology itself, where the working group recommends the use of a daily non-cumulative compounded rate. So you'll see on screen a table setting out the key features of cumulative and non-cumulative compounding methodologies. Looking first at the cumulative compounding methodology, this looks at the daily overnight SONIA rate on each day during an interest period and then compounds that rate over that period. Compounding the rate on a daily basis ensures that day-to-day fluctuations in SONIA are effectively smoothed out over that relevant period, reducing the chance that any volatility in the rates will have a marked impact on the amount of interest which is payable at the end of the period. Using the cumulative compounding methodology produces an overall compounded rate at the end of the observation period, meaning that this approach does not result in an accurate determination of the interest rate or indeed the amount of interest which is payable at the end of the observation period during an interest period, making intra-period events such as prepayments more challenging for lenders and agents. However, on the other hand, the benefit of the cumulative compounding approach is that only one calculation is required, and that's at the end of the observation period. Therefore, although the working group's recommendation is the non-cumulative approach, which I'll come on to talk about in a moment, we've seen some banks use the cumulative approach either as a result of the way that their systems are set up or simply because it's less burdensome from an administrative perspective. Flipping to the other side of the slides, you can see that the key points relating to the non-cumulative compounding methodology. In effect, this approach, unlike the cumulative compounding method, produces a compounded rate for each day during an interest period, making it easier to calculate the amount of interest payable on any given day in that period. As you can see, the non-cumulative compounded rate is, in short, the cumulative compounded rate for the previous day subtracted from the cumulative compounded rate for the day the non-cumulative rate is being calculated. Due to the likelihood of intra-interest period events in particular financings, so for example, prepayments or loan trading, the preference in the market is to use the daily non-cumulative compounded rate methodology. So as we've said, this is supported by the working group's own recommendations and is also reflected in the Loan Market Association's draft risk-free rate template documentation as well. As a side note, it's for the same reason relating to intra-interest period events that the working group's recommendation is that zero floors are also applied on a daily basis as well. So finally in this section, let's look at the credit adjustment spread concept, which Anna gave a brief overview of before. Something that's important to keep in mind with the transition process is that parties will ultimately want the same, or as near to the same as possible, economic outcome, regardless of the reference rate which is being used. On the one hand, banks have a duty to treat customers fairly, but it's also important to remember that banks and other lenders are also not expected to be penalised for the transition away from LIBOR either. As Anna mentioned, SONIA typically fixes at a lower rate than LIBOR, as it does not include this credit or liquidity premium, which is inherent in the interbank market on which LIBOR rates are or continue to be based for the time being. For new loans, this means that lenders are likely to increase their margins slightly to ensure that they maintain the same, or as near to the same as possible, as I said, return as they would have pre-transition, so that comes down to pricing. For existing loans which currently reference LIBOR and which are being amended to include rate switch provisions or immediate SONIA provisions, some banks are including what's known as the credit adjustment spread, or CAS, in their interest rate calculation. This is important for existing contracts because without a credit adjustment spread, there may be an unintended transfer of value between the lender and the borrower as a result of the transition away from LIBOR, transition from LIBOR to SONIA. So the all-in rate here for a sterling loan in this scenario is therefore margin, as it was before, plus compounded SONIA rate, plus credit adjustment spread, or CAS, as I said. The floating element of the calculation pre and post transition is shown in the fairly basic diagram on the slide, where LIBOR is effectively replaced by SONIA plus CAS. The emerging accepted practice for CAS is to use the median difference between LIBOR and SONIA calculated over a 5-year period. This was fixed on the 5th of March this year, which was the date of the Financial Conduct Authority's announcement on the future cessation of LIBOR benchmarks. CAS rates are published by Bloomberg, which provides these rates for various currencies and various tenors. From the transition work we've been doing over the past 6 months or so with lenders and borrowers, including live transition work we've got on at the moment, we've had experience of these CAS rates being used in amendments to loan documentation, so that this CAS concept is being used in practice. And finally, from me, I'm going to give a brief overview of SONIA term rates and also the use of some non-risk-free rates in the context of LIBOR transition as well. So looking first at SONIA term rates, while UK financial authorities have expressed a clear preference for the adoption of the SONIA compounded in arrears methodology, there is a lot of discussion in the market about the use of forward-looking risk-free term rates as well. So although these rates are produced on a different basis than LIBOR, which, as we've said previously, is itself a forward-looking rate, the practical outcome is the same. So at the start of the interest period, you know the rate of interest which applies to your loan for that period, and therefore you know how much interest you'll be paying at the end. Contrasting this with the backward-looking compounded in arrears methodology, which I've just run through, where borrowers only know how much interest they owe, for example, 5 banking days before the end of their interest period, you can see the clear attraction for the parties and in particular borrowers in that context. Forward-looking risk-free rates are based on transactions in the derivatives markets and reflect market expectations on future movements in those rates over a particular period. The methodology is therefore broadly similar to LIBOR, except that the risk-free term rates do not include the credit or liquidity premiums which we've mentioned. Forward-looking term rates have a particular use in certain settings, such as small business lending, export finance, Islamic finance, and tough legacy contracts, which Nicola will come on to talk about shortly. So those are settings where the complex compounded in arrears methodology is unsuitable, for example, due to it being particularly important to the parties to know how much interest will be payable at the start of an interest period. Forward-looking SONIA rates for sterling loans are already produced by Refinitiv and ICE Benchmark Administration Limited. However, neither of those have been formally adopted or recommended by the Sterling Working Group as yet. This is principally, we think, because they, along with other UK regulators, are keen to ensure transition of the market to the compounded risk-free rates as an immediate priority. The backward-looking compounded risk-free rate methodology is also seen as a preferred approach in a multi-currency setting. It's, at least for now, unlikely that forward-looking risk-free term rates will be available for all currencies and all tenors. So using the compounded in arrears methodology across all currencies in a multi-currency facility would therefore promote consistency and also decreases the operational burden for market participants, in particular lenders and agents. Perhaps an interesting development out of New York recently was the announcement by the Alternative Reference Rates Committee, or the ARRC, which is the US equivalent of the Sterling Working Group. And the ARRC has formally recommended the use of CME Group's forward-looking SOFR rate, term rate. The SOFR being the Secured Overnight Financing Rate, which is the US dollar equivalent of SONIA. As I said, the Sterling Working Group has not yet formally recommended a forward-looking SONIA term rate as yet, but it's certainly something to look out for. And in particular, what the working groups say around recommended use cases for such a forward-looking term rate. So moving on to alternatives to risk-free rates, I'm sure it's quite clear from your own experience with LIBOR transition and what Anna and I have discussed so far that there are certainly some operational and documentary challenges involved with the use of the compounded SONIA methodology. In certain settings, this complexity is likely to be undesirable, and I think in some cases completely unworkable for the parties. So for example, if I would like to make a loan to a small business with a floating interest element to the overall rate, for a number of years now, I would have probably used LIBOR for that purpose. Following the cessation of LIBOR, however, it's unlikely that I'll want to amend my loan documentation to include the same complex compounded SONIA methodology that perhaps a bank or more sophisticated lender would. My borrower is also unlikely to want to pay for the amendments, and I likely don't have the time or systems to carry out the complex calculations which are required. I would therefore be looking for another reference rate for the floating element of the interest that I'm looking to charge on my loan. Alternatives to LIBOR and compounded risk-free rates might be a central bank rate or simply adopting an all-in fixed rate. As I mentioned, there's also SONIA term rates being published, which may be appropriate in certain circumstances as well. So in the example I've just given, the Bank of England's base rate is likely the option that I would choose. The benefit of using the base rate is that it tends to track SONIA fairly closely, and so in that sense is economically similar. And also the Bank of England's base rate is readily ascertainable and rarely fluctuates as well. Looking outside of the lending or borrowing scenario, the issue of LIBOR cessation will also be relevant for some other commercial contracts too. For example, in late payment clauses, which currently reference LIBOR. We've had some recent experience of such contracts and clauses of that nature being amended to refer to the relevant central bank rate as an alternative to LIBOR. And that's not to say that that's the only or best option in all or every case, but it's certainly something we've observed in practice. I'll now pass over to Nicola, who's going to discuss tough legacy contracts, as well as some of the issues which may come up as we transition away from LIBOR and that reaches its conclusion at the end of the year.
Thanks, Martin. So yes, I've been asked to speak today about current market issues in connection with the LIBOR transition, so a little bit different to the previous sections there. And what I'm going to speak about first is tough legacy contracts, and then after that I'll move on to a couple of other issues that we've seen arising. So tough legacy contracts. Before diving into the specifics of the current proposals and the recent updates on tough legacy contracts, I thought it would be worth just taking a minute to explain exactly what a tough legacy contract is and why they have become such a talking point in the market recently. So I'll take you back to Anna's introduction. So we've got back on screen the timetable for LIBOR transition, which was set out by the FCA in May. And we're going into Q4, where you will see there are two important milestones, which are be fully prepared for the end of LIBOR and LIBOR ends. So the discontinuation of LIBOR, it's obviously been a really important and a large exercise for all of those working within financial services. And I'm sure many of you attending this seminar have already spent great amounts of time and energy preparing for it, particularly over the last couple of years. And what you might have been doing is reviewing existing loans to ascertain whether they need to move on to another type of interest rate, and then liaising both internally and externally to decide how to make that move and to make the move. But what if, despite your best efforts, you end up on the 31st of December and you just cannot move a particular loan or a product from a LIBOR rate onto a non-LIBOR rate? What happens then? And that, in a nutshell, is the problem of tough legacy contracts. So to understand tough legacy contracts, we have to consider what we mean by you cannot move a loan from LIBOR to non-LIBOR. And I don't have a definition up on the screen, but generally, when we're speaking about tough legacy contracts, we're considering contracts in quite a narrow set of circumstances. So they're generally all in areas where the practicalities in terms of obtaining consents or approvals is so problematic within the timescale that it is virtually impossible. So we see these in areas such as retail mortgage portfolios. So that's because these tend to contain a number of personal mortgage customers, and they may not actively respond. If they do respond, they may decide not to give consent. And the other side of that is that the holder of those mortgage, if it's a historic mortgage, they may no longer be registered or regulated in the right way to be able to amend those products or replace them if need be. So the FCA is currently estimating that this affects around 200,000 mortgages in the UK. The second area is quite similar. It relates to bond issues. So you can have bonds issued with numerous bond or note holders, and there may firstly be issues in terms of tracing those note holders, and then secondly, in terms of obtaining all of the consents. So again, you could see how that could be impossible within the limited time frame. So the FCA are currently estimating that that will affect numbers in the low hundreds of bonds. Thirdly, certain areas in derivatives and complex lending. So that might be where one transaction might have an unintended consequence on a larger financial arrangement, or it may be where there is a tough legacy as one part of a larger financial arrangement. And the last area, which is sometimes included in tough legacy definitions, is syndicated lending, where all lender consent is required for any change to an interest rate. The reason for that might be just trying to get numerous lenders to all agree on the same formulation and the same detail of the changes that are needed. So tough legacy contracts, we've been discussing them for some time now, and it's generally been the view of the regulators that despite the issues, it's just not acceptable for LIBOR to continue to be used after 31st December 2021, even if only in the limited and reducing scenarios that we've spoken about on the previous slide. So I've got on screen now a quote from the working group. So they believe that active transition of legacy LIBOR positions is the only way parties can have certainty over both the continued operation and the future economics of their contracts. Any alternative solution, including proposals that they discuss in their paper, are not certain to succeed, and they may not be economically neutral or suitable for particular contracts. So if we're in a situation where LIBOR can't be used after 31st of December, but we're also in a situation where for some contracts, they can't be changed to move away from LIBOR, then how do we how are we proposing that these financing arrangements continue? And the answer at the moment is that we're moving towards a manufactured rate for use in tough legacy contracts, which is representative of LIBOR and therefore commercially appropriate in the context of these agreements, but also based upon reliable methodology in line with the ethos of the LIBOR transition. And these rates are what we are commonly referring to as synthetic LIBOR rates. So in June, the FCA started to publish its latest consultation on the use of synthetic LIBOR after 31st December. And what they are currently proposing is that they will use new legal powers to require the ICE Benchmark Administration to continue to issue a synthetic LIBOR rate. So those rates will be available for 1, 3, and 6 month terms, and they'll be available in sterling and Japanese yen. The publishing of these rates will be limited in time, so it's intended to be a further transitioning tool rather than an end game, but the time frame in which those would continue to be published is currently uncertain. And the rates will only be allowed to be used for contracts which are recognised by the FCA as tough legacy contracts. So I set out earlier what are generally considered to be tough legacy contracts, but I didn't include a definition of tough legacy contracts. And the reason for that is that we're yet to see any kind of formal list or formal description of what tough legacy contracts will be for the purposes of these proposals. So the consultation has been ongoing and it closed on the 27th of August. So we're expecting a further update on this issue fairly soon, and certainly in the fourth quarter of this year before the 31st December deadline. So I've got another quote here from the FCA from a keynote speech. It says, "Market participants are encouraged to amend their contracts where they can. There is no need to wait for our synthetic LIBOR decision before doing so." And I think that just shows that really the position here is that everyone should avoid using tough legacy fallbacks if at all possible. And it is at the moment deliberately unattractive to wait and find out what these provisions are, because if you can move your loans, you should do that. So earlier on, Anna had set out the difference between LIBOR and SONIA, and Martin's obviously taken us through in some detail the differences in the new rates that are available. So I thought when we're speaking about synthetic LIBOR, it might be worth just having a quick look at the difference between LIBOR and synthetic LIBOR. So both would be forward-looking rates. The new synthetic LIBOR would be based upon SONIA or TONA for Japanese yen, with a credit adjustment spread which is aligned with historical LIBOR. It's a 5-year historical median. The LIBOR rates were obviously available for multiple terms and daily rates, but synthetic LIBOR will only be available for 1, 3, and 6 month terms. And synthetic LIBOR will only be available for sterling and Japanese yen. So that's tough legacy contracts. So in the last section here, I just wanted to give some other thoughts as to kind of issues and points of interest that we have been seeing as the LIBOR transition enters its final stages. So LIBOR transition obviously has a global impact. And one thing which has been discussed right from the outset is that it's appropriate for the international community to take a streamlined approach to the change in rates. So just to give a quick kind of around the world, Europe is following a similar IBOR transition exercise, and they're moving from EONIA and Euribor to the Euro STR, the Euro short-term rate. They're looking at a similar time frame, so they're hoping all loans will be moved by 31st December 2021. The Norwegian loan market has historically followed US dollar LIBOR policy, and it's doing the same again with a move from NIBOR to NOA, the Norwegian overnight weighted average. The Hong Kong Monetary Authority, they're taking a slightly different two-prong approach. So they are following a similar approach in relation to LIBOR-linked loans, and they are suggesting that those should all be transitioned onto an alternative rate by 31st December. And they're also publishing a new HONYA rate, but they are currently not proposing to discontinue the HIBOR rate, and this can continue to be used from 2022. And in relation to the US, the dollar 1 week and 2 month LIBOR rates will cease on 31st December, but all other rates are intended to continue for use until June 2023. In the state of New York, however, there's some specific legislation which will move contracts governed by New York law, which reference LIBOR, automatically to referencing the secured overnight financing rate. And that legislation also includes safe harbor provisions relating to those changes. So the FSB had reported to the G20 committee with the quote that I've got on screen at the moment. So borrowers have reported little to no communication from their lenders on LIBOR transition and lack of availability of robust alternatives to LIBOR-based loans. I thought it was worth reviewing and discussing this because this quote comes from July 2021 and it relates mainly to business loans in the UK market. It obviously shows a view of borrowers in the market. And LIBOR transition is now live across the market, and we do see LIBOR being actively discussed and LIBOR transition information being passed by lenders to borrowers. So where is this view coming from? One thing, we can't deny that the change in rates here is quite complicated. Martin's taken us through it in some detail, and it's not very friendly for borrowers and end users, particularly if you're not based within the financial services industry. And we know that there can be a fine line between too little information and too much, and maybe the impact of both is a feeling that you've not received the information you need. So perhaps this could explain the comments that are coming out here. Also, as Martin mentioned, it's not easy to calculate and apply SONIA over interest periods, and there really isn't an easy solution from moving from LIBOR. You can move on to a base rate loan, but there's not something that can just be slotted into contracts for changing from LIBOR to a SONIA-based loan. So perhaps there is a feeling that people are looking for an equivalent that's not there and feeling a bit frustrated that it's not yet been made available. Thirdly, in terms of the move from LIBOR, there are obviously costs involved. There are costs in terms of amending documentation from LIBOR rates to an RFR. And many of the changes that we've seen to date are being wrapped up within new loans or loan amendment exercises. But as we approach this final push, it's becoming clear that some borrowers are viewing LIBOR transition as a bit of a banking problem and are not very keen to pay the costs of any amendments, particularly where those involve things like overseas legal opinions. So I think just in the final 3 months, it's worth noting that there might be an increase in kind of pushback from borrowers in terms of the costs and also in terms of finding an easy alternative here. Linked to this, as Martin explained previously, one of the biggest differences between LIBOR and moving on to SONIA or other RFRs is that interest is only calculated at the end of the relevant period, or in the best case, 5 days before. And that's quite a significant change in terms of cash flow management for many businesses. So the sorts of questions that we are regularly being asked at the moment include, how will I know what I need to pay? Will I get some kind of estimated figure at the start of the interest period? What happens if the amount is significantly more than I expected? And will we be advised more than 5 days ahead if there are significant changes in the rates? So those are the kind of issues that are arising at the moment as we really start transitioning onto SONIA and other RFRs. And those are the sorts of issues that will need to be addressed in order to get to 31st December with everyone feeling completely ready to move away from LIBOR. So that's everything that I had to say in terms of tough legacy and other market issues at this time. So I will pass back to Anna now for some questions in the final part of today's seminar.
Thanks, Nicola. So we have some time left in the session to answer any questions you might have, so please feel free to pop those in the question and answer session, and remember please to make a note of your name and contact details, and if we don't have time we will follow up with you after the session. So our first question is, with SONIA, are we expecting the same risk of negative interest rates that we have seen in relation to LIBOR referencing loans? Martin, I think you touched on this one in your part of the presentation.
Yeah, that's right. I touched briefly on zero floors. I think, if anything, the risk of SONIA rates going negative is potentially higher than with LIBOR. I think I mentioned that SONIA tends to track, in an economic sense anyway, in the same direction as the Bank of England base rate. So if the Bank of England base rate was to go negative, there's a good chance that SONIA rates would as well. The Bank of England have for a while now not expressly ruled out negative base rates, although it's not clear if or when that could actually happen. I suppose, as I said, in the context of SONIA, there's zero floors are still relevant. Zero floors being, of course, zeroing negative reference rates so that the lender's margin is preserved, and credit adjustment spreads are being applied. I think I mentioned before that the zero floor applies to the whole floating element of the rate there, as it would have done with LIBOR. So in that case, the compounded SONIA plus the credit adjustment spread.
Thanks, Martin. Martin, there's another question for you here. Martin, you mentioned that some lenders are using a cumulative compounded SONIA rather than non-cumulative as recommended by the working group, because that worked better for systems they have in place, or because it is less administratively burdensome. The question is, are you seeing lenders not following working group recommendations on any other aspects for these or other reasons?
Yeah, that's a good question. I suppose generally the short answer to that question is that we're observing that the working group's recommendations are being followed in the market. There's a lot of transition activity ongoing at the moment, and that's what's generally coming across our desks. I suppose, as with a number of what's market type questions, the position set in the loan market associations template documentation tends to be followed, or is certainly a useful touch point. And it's useful to note that the LMA's template documents have generally adopted, or at least facilitate, the adoption of the working group's recommendations. Just circling back to the cumulative versus non-cumulative point. So I think I mentioned on this slide on that particular topic that provided the same rounding conventions, or the recommended rounding conventions of the working group, are used, the same amount of interest should be payable at the end of the period, or overall the same amount of interest should be payable. So for the end user, there shouldn't really be any difference apart from the point I made about intra-interest period events, so things like prepayments and loan trailing. So although that's maybe a slight deviation from the headline recommendation of the working group to use cumulative rather than non-cumulative, ultimately the end result will still be the same. But generally, as I said, the working group's recommendations are being adopted in the market by market participants.
Thanks, Martin. Nicola, there's a question for you here. You mentioned that the state of New York has introduced a change in legislation and safe harbour provisions. Do you think we are likely to see safe harbour provisions in the UK?
Yeah, I think the short answer is probably not, but maybe. So yeah, New York has carried out legislation to automatically amend contracts to move to SOFR, and in connection with that, yes, they have included safe harbour provisions, both in terms of confirming that contracts will continue as amended by the legislation, but also including protection from litigation. At present, it's not likely that we will have similar legislation to automatically change rates other than potentially in tough legacy contracts. So safe harbour provisions would only be appropriate in connection with changes like that. So the EU has been speaking about including safe harbour protections for tough legacy contracts that confirm that the contracts will continue as amended and not be challengeable on that basis, but they're not considering taking in protections from litigation. So it might be that the UK follows a similar approach, and the UK government did suggest to the working group that they would consider doing that if the working group recommends it. But at the moment, we don't have that clarity on what will happen with tough legacy contracts. So I think that needs to happen first, and then the working group will determine whether the safe harbour provisions are appropriate. And at the moment, they do have power to include some safe harbour provisions in terms of the continuation of contracts, but not in relation to protection from litigation. So if that is appropriate, then that will need new legislation to go through. So I think possibly, but probably not, and certainly not very quickly.
There's another question here on synthetic LIBOR and tough legacy contracts. If synthetic LIBOR is only going to be in place for a limited time frame, what does this mean for contracts which rely on synthetic LIBOR after the 31st of December and which run beyond the end dates for publication of synthetic LIBOR? Nicola? Yeah,
I mean, we don't know what that end date will be, but I think it's pretty clear that what the synthetic LIBOR is doing is kind of kicking the can down the street a little bit. It's not an end game. So yeah, at the moment, we don't know until it's completely confirmed what will happen with tough legacy contracts after 1st of January. If it's the synthetic LIBOR that's currently being proposed, then it will end at some point, and we will have the same issue again at the end of that, unless all contracts have been moved somehow from LIBOR onto something else before that date.
I think we've got time for one last question. Nicola, this one is for you. You mentioned that legacy contracts are likely to be defined quite narrowly. What does this mean for contracts which don't fall within the definition, but which have not been amended prior to the 31st of December to include robust fallbacks or the switch across to SONIA?
Yeah, again, we don't really know. I suppose it depends on what each contract says. It's very much a case by case basis. You know, did it have LIBOR fallback provisions in it? What are they? Were there unavailability of rate provisions? Were there cost of funds provisions? So there's quite a lot to think about in those. But I think really the quote from the working group that I put up on screen earlier is really relevant. The only thing that is certain is uncertainty, and there could be unintended consequences to contracts if they're based on LIBOR and nothing's done to change them off of that before the 31st of December.
Okay, thanks, Nicola. Thank you everyone for joining us today. We will circulate a link to the recorded session after today's event. Thank you.